All right, welcome everyone to this month's edition of the Investment Committee webinar. Appreciate you all joining us today for another exciting month in markets. Today we have our market update for you, just taking a look at what's happened so far in 2026. Then we want to cover some recent news stories and headlines that we've seen over the last month. And then we have an interesting chart that we want to show you guys that we think is pretty impactful. So looking at the market vitals so far in 2026, the S&P 500 is up about 1.2%, but that has not been the major story, I think, so far in 2026. If we take a look at some of these other major indices that we track here over on the right, there's a couple numbers that really pop off the page. The international stock index up 7.3%. So that trend that we saw emerge last year has just continued into 2026. And then one of the themes that we mentioned on last month's webinar, looking at small cap companies, the other 493 companies outside of that top Magnificent Seven, as they call them, maybe they were starting to outperform a month ago, and we said that was a theme to keep an eye on in 2026. Looking at the numbers so far, the Russell 2000 small cap index is up 7.6%. So that's a big story so far this year. And then one more thing I want to highlight is that NASDAQ 100 technology heavy index is actually down so far on the year. So for a part of the market that has done so well over the last 3 years in technology, off to a sluggish start so far in 2026. If we take a look at Bitcoin, it has had a volatile start to the year, and some other assets like gold and silver are almost trading like cryptocurrency so far in 2026. We saw silver have a 30% down day, gold have a 10% down day. So there's been a lot of volatility in some of those currency hedges and safe haven assets like gold and silver. Brandon, what have we seen in terms of some of the sectors and the growth versus value conversation so far in 2026?
Yeah, Sean, I mean, to your point from the major index performance, the NASDAQ being down this year to date versus the Russell being up or international. If you look over the past 3 years, you were really seeing that positive momentum from, that large cap growth section. And similarly, right now you're seeing value outperform from large cap, mid cap, and small cap. And then, similarly, the small caps are, outperforming those large companies. So you're starting to see a trend, start to move away from those large concentrated positions in the Magnificent Seven and some of those AI companies where you're starting to see, the small and mid cap companies catch up, but also the rest of the market from a value perspective, which is really like mature, established companies. If you think like Coca-Cola, you're starting to see, more positive momentum from them, where, this is kind of a story from, the small and mid caps from the past couple years of, oh, this will finally be the year where they start to catch up to the rest of the market. And, through the first, month, basically, you're starting to see that. And it'll be interesting, as we continue to do these webinars month over month is, how this trend changes. Is this kind of just, 1 month of volatility, or is it going to continue to play out this way for the rest of the year?
Yep. One more thing to highlight. We always love to highlight that money market rate. It's at about 3.5% right now. So that will continue to shift as rates get cut, which is the expectation right now. But I always want to keep you guys up to date on what that current money market rate is in terms of your ability to earn some yield on cash.
Brandon, Sean, as you're just going through this before we flip to the next page, and one of the things you guys highlighted was, where in previous years, large cap, heavy growth, the big tech, the Mag Seven, the names and the companies that we all recognize and use on a daily basis, those were winning the game, and all the other companies were kind of just lagging behind. And now we've got this, what seems like almost like a reverse of that story as you're describing. How should the listeners and just generally market participants interpret that? Is that good, bad, just interesting? How do you guys take it?
Yeah, I would say it's just interesting. I wouldn't say it's good or bad necessarily. People have relied, I think, a lot on the Magnificent Seven and have kind of gotten used to this new market regime over the last 3 years that it's kind of ingrained that, oh, those seven stocks are the best stocks to own at any given time. This kind of just proves that point of markets are constantly shifting, trends are constantly changing. So you need to be nimble and be able to adapt and shift your portfolio at different times. So it's super important to keep your ear to the ground and be cognizant of these shifts in market trends, and what names are doing better, what sectors are potentially in favor or out of favor. It just shows how quickly things can change, but I don't think it's necessarily a bad thing for markets. I think it's good to see the breadth of the market start to perform a little bit better and not just rely on those seven names.
Mhm.
Yeah, I think that's an important point to just kind of, reiterate. It's if you look at a town and you say, I wonder how that town's doing, and only one house is going up and the rest of the houses are not going up in value, then
Mhm.
it's tough to say the town's doing great. But if all the town prices are appreciating and everyone's house is worth more, then you can probably say the town's doing pretty good. So we call this as a broadening of the market, and that usually means the rally is more robust and therefore less prone to failure, and people usually have a little bit more confidence in it. So generally speaking, yes, interesting to point out as an investor, if you're not in these other places, that can sometimes be hard to interpret, as you kind of highlighted, Sean. It's got a little bit of a mixed view from an investor standpoint, but from a economy standpoint, this is kind of looks like a good thing.
Mm. Yeah, that's a good point.
Brandon, anything else you want to throw on top of that cake?
Yeah, no, and to Sean's point, I mean, and yours, I think it's also important, as you're looking at the trends, and kind of following that momentum of what's doing well, what's outperforming or underperforming is also just realizing the moment in time too of how this kind of continues to play out. Whether this continues, whether it kind of changes, but also, we're only a month into the year. Just to really notice how it goes from month to month or, week to week. You also kind of just want to take into consideration, the last 3 years too. Um, but just looking at, kind of all the different viewpoints.
Yeah, we're only 40 days into the year, and I feel like we're 4 months into the year. It's crazy.
Yeah. A lot of news stories and market changes going on, so it's an exciting time. Looking at some other items here, the US dollar was a large story in 2025. It was down about 10%. We've continued to see that trend in 2026. The US dollar is down another 1.3% so far in 2026. And I think there's a lot of factors that play into that. The tariffs that we saw in 2025, the trade deals that are happening internationally, some of the geopolitical tension, all has kind of coagulated into the dollar continuing to lose value a little bit, which helps those international stocks perform better. In terms of the treasury rate, right now we're at 4.2%, and we just had a new Fed chair appointed, Kevin Warsh, in the last month. So people think,
Correction, not appointed. He has been let's say announced as the nominee for May when the
yes,
appointment is up for the vote.
thank you for that clarification. And he's generally on the hawkish side, is what people think. Although Trump has mentioned that he wants rates to be cut, likely. So it'll be interesting to see exactly where on that scale he ends up landing. But I think generally a pretty good Fed pick. I think he has some experience, and no no major red flags. So any thoughts you guys have on the Fed appointment, or what to expect moving forward in terms of rates?
I think you got it right. I think the expectation of the picks was I think the market was a little concerned, and I don't know if it knows what it was concerned about. It was
Mhm.
just kind of like, that crazy cousin that says I'm bringing my girlfriend or boyfriend to dinner, and you're like, uh-oh, who's that going to be? And then it's like they show up and yeah, they're totally normal and cool. Uh, so no, I think he was a good choice, and
Yeah.
um, he should, he's very well respected. It's hard to believe he didn't, make a little bit of some noise in a manner that made Trump feel like he was going to be less hawkish
Yeah.
than the market feels. And the market's been kind of, it seems like weighing that back and forth over the past couple weeks. Uh,
Mhm.
it's been interesting to hear the commentary around it. He's supposed to be silent, by the way, all the way up until he is actually in the seat. He's not supposed to be doing press conferences or anything like that. And we'll see how that goes. That's going to be because then he could kind of be whoever you want him to be if he can't talk for
Yeah.
himself, really. So it'll be interesting, and whether or not he's actually going to abide by that will also be interesting to see.
Yeah, and the expectation right now is 50 basis points of cuts in 2026. I think there's a lot of factors to weigh in terms of what the expectation is going to be. As we just mentioned, a new Fed chair potentially taking the seat this year, and continuing to look at a lot of those data points. We have an inflation reading coming up this Friday. We had a jobs reading this morning that we're going to get into a bit later. So continuing to look at the data and also weigh what's expected out of the new Fed chair nominee.
It's probably worth noting, even though we expect two cuts in 2026 currently, if we had rolled the clock back 6 months ago, we would have expected more than two. I think we had three for the first half of the year and then potentially one or two more in the back half of the year, depending on when you looked at it. So it's been a dramatic revision down of how many cuts are expected in 2026 over the past 6 months.
Yep, absolutely. And the first month of the year, there's been no shortage of headlines, that's for sure. We included some of the major headlines that we thought were important to highlight here through the first month. There's been some new AI infrastructure winners emerging. So one great example of this is a company called Lumentum, which is really focused on building up the optical and photonic infrastructure for data centers. So really more on that hardware, physical side of AI, providing that utility and energy for data centers. And just looking at the last year, this company is up 610%. So just an example that this AI trade and AI boom continues to benefit a number of different sectors, a number of different companies, and there's going to continue to be these new players that emerge that greatly benefit from the AI cycle that we're currently in. And there's also been new types of companies thriving. As Brandon was mentioning on the first slide, value has really started to outperform growth. Some of these high asset, low obsolescence or halo companies have been thriving recently. So companies that really trade physical goods and have higher assets on their balance sheet, Pepsi, Coke, as Brandon mentioned, Johnson and Johnson, ExxonMobil. Some of these companies that have a lower risk for AI disruption have seen a real large boost so far in 2026. And on the other side of that, we've seen sectors like software have a real repricing so far in 2026. So companies that are low asset and are more focused on consulting or providing software and have really high margins. Some examples being Salesforce, Adobe, Workday, have all seen pretty steep declines in 2026 so far. All three of those examples right there are down over 20% since the start of the year. So while some sectors are thriving and some companies are thriving, others are seeing some declines and repricing. So it's been a very interesting start to the year, and a market in transition is the theme here. Magnificent Seven, as we talked about the last 3 years, has carried the torch for the market. So far in 2026, the average performance of those seven companies is down 2.5%. So some of the Magnificent Seven, like Amazon and Microsoft, are down double digits so far, while others are trading around flat. So that has been a story so far in 2026 is the other 493, as we talked about, have really started to step it up and see more of a rally. And then the last headline we want to mention here is trade and policy have really started reshaping capital flows. So tariffs from 2025, geopolitical tensions, US dollar losing value, all of these factors have led to more international investment, and you can see it also in the inflation rates. Europe has below a 2% inflation rate currently, while the US is still floating around that 3%. And it's really been sticking around that 3% level, kind of tough to get that down. Uh,
Yeah, and I think if you like look at these headlines versus everything that is going out on in the world from markets and globally. And then you kind of look back to the first slide of the performance data from the major market indices, and then also, value versus growth. I think a lot of these headlines put in perspective of, how that performance is actually, interacting, whether you're kind of looking at Sean's point from, those halo companies thriving or new AI infrastructure, which could be, if you're looking at some of the industrials or utilities, a little bit more tangible than some of the, software where they're, have huge spending amounts and could potentially, really profit from future gains, but, maybe harder to digest of when that actually comes to fruition. So I think, these, a market in transition news stories really give a good kind of overview of how that's, what's focusing on the market and some of the performance data from the first slide. And same with some of the, international too.
Yep. Awesome. We just also wanted to focus a little bit more on this software Death Valley story. A lot of uncertainty for software companies, I think, for a couple of reasons. The fear that artificial intelligence could upend some of these traditional software businesses. As we talked about with those Halo companies, there's not a lot of fear around some of those high asset companies and what AI could do to replace them or disrupt them. AI can't sell you a Diet Pepsi. It can't move your package like UPS. So some of those physical companies are not seeing as much disruption as these software companies like CRM, Adobe. Um, so Jordan, what would you expect in terms of like revenue and earnings for some of these companies? And what are your thoughts on some of the new pricing models that companies like CRM or HubSpot have been talking about recently?
Well, if we just start why we even labeled this slide SaaS Death Valley, and that was a term that was used in 2013 to about 2016 regarding Adobe. And Adobe is one of these SaaS companies, software as a service companies, and what they had at the time was a perpetual pricing model. You'd basically buy your computer, you'd buy the Creative Suite or Adobe Photoshop, and you'd pay a steep price upfront, and that would give you that license, forever. And if you didn't lose your license key card or anything else, you could kind of move it from one computer to the next, and you'd kind of decide when you wanted to upgrade it. And they made a choice in 2013 where they said, we're going to stop selling those licenses and we're going to start charging people monthly fees for, their cheaper products like Adobe. It was like $15 a month. And for the Creative Suite, it was more like $50 a month. And that change ultimately led to a drop in their revenue steeply in the year, in the next 12 months following that announcement. The revenue dropped 65%. As you can probably guess, their stock dropped similarly because Wall Street was very focused on the near-term impact of the revenue and how that was going to impact earnings. Over time, though, the reason why it's called a valley is a valley kind of goes, two ways. You get a V a little bit. And what ultimately happened is Wall Street started to recognize the benefit of recurring revenue, the subscriptions that they had, and they were able to onboard smaller customers who couldn't afford the high entry costs of the perpetual license model. So come in today, why are we calling it the software as a service Death Valley? Because AI is ultimately changing the way that a lot of the software companies are having to engage with their customers. Most software as a service companies have adopted that monthly subscription model. It's usually based by seat or user, and there'd be a per monthly charge. And now with users being able to use AI, that means maybe there's less users needed within the organization, giving some people like viewer rights. There's some consumption-based pricing that's built into some of these new models that we're starting to see. And the reality is it may continue to evolve as things go. So we don't know exactly where it's going, but we start to see how these companies are already having to make impacted changes. They've even started making some companies making these changes since 2024. So this isn't really new. It's kind of new that the markets had a little bit of an anxiety attack over what's going to happen to these companies and where their revenues are going to go, where their customer base is going to go, whether or not, they're going to see new competition or what's going on. There's been a lot of concern. If you watched even 20 minutes of CNBC at any point in the last 2 weeks, you heard someone's hair on fire over the whole thing. We're a little bit more calm about this. Again, bringing up that Adobe example, we've kind of seen this before where new pricing structures make sense for customers to access software. And even something as silly as, your cable box and the monthly bill for the cable box switching over to online subscription services. You can log in anywhere, you can do it on your phone, you can have it on 10 TVs in your house. Whereas the cable box, you'd have one, and if you want to get a new TV, it was installation charge and these monthly service fees for the cable boxes. It ultimately consumers want to consume their TV a little bit differently. There's pros and cons to it, right? All of us kind of miss that time when you could just grab one clicker and turn it on and you had all your channels right there versus 10 subscription services that we're all paying for. But this is ultimately the way the world is kind of changing. It can be bumpy for these companies for a period of time. But we find it pretty hard to believe that, while Wall Street is imagining a very fast and rapid change that's going to be disastrous for these companies, so far the impact to earnings and revenue for these companies has been the exact opposite. Companies have seen growth in revenue. Even if you take Salesforce, one of the largest ones, their projected revenue for 2026, they raised guidance in their last earnings call. Their earnings grew at over 9%, and they've seen a lot of great adoption with some of the new features they've been coming out with. So it's a little strange kind of seeing how Wall Street is responding so negatively to good earnings and good reports. That's also a reason to be cautious, though. When you hear good news and Wall Street reacts poorly, sometimes Wall Street's wrong, but sometimes Wall Street's also telling you something that, it's not about those numbers that they just said, it might be in the future. So this is something I think people should be a little bit careful of, but it's definitely something to keep an eye on and keep informed about. Ultimately, if you have a long enough time horizon, we see this as potentially being beneficial long term because we think consumers and providers are going to win equally. The same way, consumers won when Netflix came out, and Netflix won as well. And cable companies, just had to kind of change their structure and model. So this is just something that, it's part of a regular transition. We don't think it's a reason to freak out. And there might be some great opportunities that come from it. So, we really encourage people to ask questions about it. We're watching it, but you got to be patient and have a longer term view and recognize that this story has happened before in the past, and it's a little bit different this time, AI and all, different players and different things going on. But this is just a natural kind of order of things, and we think that this is a place to stay tuned, and this is also going to be very informative of how some other companies maybe deal with their pricing in the future as things go, because that monthly subscription model for user is pretty widely used across all kinds of things like gyms and all other types of things that have nothing to do with SaaS, but it's people find a benefit to monthly bills versus big upfront bills, and this is going to be kind of the same of maybe it's not just monthly bills, maybe it's small monthly bills plus some utility, how much I use bill. And it's going to be interesting to see how that kind of conforms to what works best for consumers and the producers themselves.
Mhm. Awesome.
I didn't hold to my I'm not going to make it too long, Sean. I think I ran that one a couple minutes longer than I had promised.
Okay, you crushed it. I loved it.
All right, so earnings outlook so far. About 60% of the companies in the S&P 500 have released earnings, and these are earnings reports for Q4 of 2025. 76% of them that have been released had a positive earnings per share surprise, and 73% reported a positive revenue surprise. Uh, so far, the year-over-year earnings growth rate for the S&P 500 is 13%. And if it ends up being 13% after all the companies release their reports, this will mark the fifth consecutive quarter of double digits earnings growth. So positive earnings growth reports so far. Leadership narrowing and talking about the Magnificent Seven, the Mag Seven are on track to bring in over a quarter or 26.6% of all S&P 500 earnings in 2026 and account for a little more than 30% of the index's total market cap. And NVIDIA is the last company of the Mag 7 to report earnings, which is coming out on February 25th. Sentiment overall is high, though. Their big three customers, Amazon, Alphabet, Microsoft, reported a combined $500 billion in 2026 of capital expenditure. And it's expected that most of that will go toward NVIDIA. An eye out for that. The U.S. economy numbers. GDP growth surprised to the upside. U.S. GDP growth is projected to expand 2.5% versus what was expected of 2.1. And the probability of a recession in the next 12 months has fallen from 30% to 20%. For the labor market, just this morning, it came out that U.S. employers added 130,000 jobs in January, bringing the unemployment rate down to 4.3%. Just to give a little bit of perspective here, this is still up from February of last year, where it was at 4.1%. But in comparison to like November, where we had a high of 4.6% for the unemployment rate, we are cooling a little bit. And then the next inflation print comes out this Friday, February 13th. And December's CPI came out at 2.7%, while it's still above the 2% target that the Fed has. Analysts are expecting January's CPI to fall to 2.5%.
So we had there's a quick question that was asked about, can we trust the labor report? And this is certainly a topic that's come up. It came up during a labor report over the summer, and after that, one of the members of the BLS was kind of very abruptly fired by the administration because the report was horribly negative. Labor reports, they're kind of lagging indicators. I wouldn't say that there's something that, when we get the jobs report, that's really telling you what happened, in the past. One, it's last month's data. If you really want to have a little bit more of your thumb on what's going on the labor market, the ADP report is probably a little bit more on time, whereas the BLS report is going to be a little bit 5 minutes late to the party. And I would also say that usually we can kind of see it in announcements. So, you're seeing a lot of announcements about, some layoffs. Amazon just made a big layoff announcement. So, I think everyone kind of expects a soft job market. I wouldn't say that's what's driving the cart. So, whether we can trust the numbers or not trust the numbers, they're probably not way off. If we suddenly saw plus 500,000 jobs month over month over month, I would say, I would call Pinocchio nose on that one. But for these numbers like 130, I don't think they're really all that upsetting. I do think it's a big deal that, general probability of recession has gone down. So that should speak kind of well to the labor market. If companies are feeling a little bit better about their recession odds, that's a good thing. And I would also say with the unemployment rate kind of ticking up over that period of time, and one thing you didn't mention, Luciano, in the earnings that we've seen so far for Q4 of 2025 is the profit margin is coming in at 13.2%. This is the highest profit margin ever recorded by FactSet since it's been following the index. So that kind of says a couple things. One, companies are doing pretty good and keeping a lot of their money. But that also might mean they're not paying employees that they just fired recently when the unemployment rate was 4.1% and now it's ticked up to 4.3. So there's a lot of moving parts here, but generally speaking, I would say that from what we're seeing, despite all the government shutdowns and the concerns over what data is good or bad or otherwise, the economy seems to be kind of humming along in a nice, what we would call mid-cycle form. It's not the start of the race, but it's not, it doesn't feel like the end of the race either. And it's just the cycle is going to kind of go through infrastructure spend on AI. That's still happening. You've got a healthy labor market. You've got a Fed that's still, cutting, and it's not cutting in some kind of drastic, out of control. We got to save this thing before it stinks manner. It's more like yeah, we probably over tightened and now we're getting back to that kind of more normal rate. So everything actually, despite the headlines being nauseating at times and whipsawing back and forth, and we're about to maybe do something crazy over here, and then nope, everything's fine. We're right back to normal. This is actually looks, if you can take all that and crumple it up and toss it out the window, everything actually looks pretty smooth sailing on the rest of the front. So it's a weird time for sure. But generally speaking, if you can kind of get your head out of the noise, it's actually the seas are a lot calmer than they look.
Yeah, that's a very interesting point. If you were to just look at this slide alone as the webinar and say, how do you think things are going? Looks like they're pretty good.
Yeah, kicking
Economy's
ass,
looking
taking names.
healthy, earnings are positive, business as usual. But then you add the headlines and it's a whole new story.
Yeah, so I mean, here we have just a chart of the Magnificent Seven versus the rest of the S&P 500 since the start of the year. So we've already covered this a few times in the slideshow already, but the Mag Seven being down about 2.5% so far, and then the rest of the S&P being up about 4.3% this year, which is a lot different than what we've seen over the past 3 years. If you look at the past 3 years, the Mag 7 would have returned, a little over 200%, and the rest of the S&P 500 would have, returned about 40%. So you can really see how much the Magnificent Seven is driving the market and the concentration in the S&P too, with that being about, 35%. So really something to, as we've already mentioned, to keep an eye out on, continue to watch the trend and, kind of see the broader market start to have some of that positive momentum and catch back up, really to those, huge companies that have been, leading and pushing the market forwards, while the rest of the market has kind of been, lagging behind, over that time frame.
Yep. And the Magnificent Seven has put so much investment into this artificial intelligence build out. I think investors are becoming a little bit cautious of how much is being invested into artificial intelligence, without seeing a huge return on that investment yet. And I think that could be part of the sentiment of why software is starting to lag, and some of these Magnificent Seven companies that are putting huge capital expenditures into AI research and development are starting to falter a little bit. Um, but like we've been saying, it's only a month into the year, so that it's something to keep an eye on. And I think there is a lot of optimism still around the artificial intelligence boom.
Well, similar to that SaaS conversation, right? And let's go back to Adobe. You used to, get a huge upfront fee for selling software, and then they went to this very longer term monthly fee, and you had to really project the cash flows to get comfortable with it. If you look at the Mag 7 and you take someone like Google that just announced a $130 billion investment in AI infrastructure, how long does it take to make $130 billion from that investment? That sounds like a pretty long time. And look, this is a company that makes about $100 billion a quarter. So when you think about, how long that is going to take, it could take a really long time. And I think investors have to start thinking about what's the length of time that takes. If I was to bring it home and make it more of a personal thing, think about paying for your kids' college, dropping $360,000 at a premier, tier one private school, and then they graduate and get a job for $40,000. It's like, man, how long does it take to get paid back for that thing? If you're assuming paid back, if you're a child who, paid for that college, it takes a while to pay off that debt. And I think Wall Street's rightly being like, how are they going to monetize this when a ChatGPT subscription costs $20 a month? Like the competitive landscape right now is it's going to be hard for these guys to convince people to pay big bucks for this huge infrastructure spend. And it's going to be interesting to see how that plays out. And I think Wall Street's being, pretty conscious
Yep.
around that, and not negatively so. I think it creates opportunity, like you said, Sean. It's not that the story doesn't work out, but it's just a question of like, hey man, how long does it take to get paid back on that $130 billion plus how much it costs to run it, right? Because then you got the energy consumption and all the other things. What are you going to be charging for that, product that that data center is going to be producing? And that goes back to that thing you mentioned about asset heavy companies suddenly. Well,
Yeah.
guess what? Google's becoming an asset heavy company when it's, dropping hundreds of billions of dollars on data centers where we're not exactly sure how much money it's going to make for it.
Yeah.
And that's because it's such a new technology. The same reason why the SaaS companies seem scary and all these other things. We just don't know. This is a little unfamiliar. History doesn't always repeat, but it kind of rhymes. We don't know exactly how the rhyme goes yet. And this is a very healthy, natural thing that just don't get caught up in the freak out. Like our biggest word to investors, don't freak out. Just know this is a natural thing. This is the cycle of, wait, are we spending too much? Oh, we're not spending enough. It's like it's gonna go through that and it's gonna feel
Yeah.
awkward at times.
Yeah, I think from the standpoint of these companies, the alternative of not investing enough into artificial intelligence, just given the incredible optimism that we've seen, an increase in productivity, the option of not investing enough and starting to fall behind your peers and not adapt to that next stage of technology and innovation, is just as risky to not invest in these upcoming technologies. So I think, yes, the CapEx expenditures are huge if you're just looking at the numbers. But in terms of the alternative of not spending this money to keep up with the other technology giants and innovation giants, that could end up being an even bigger risk for some of these companies. So,
Well, and even if the companies invest a lot, like Amazon, Rufus is considered to be not top tier technology. And people are kind of starting to shun them, thinking they're falling behind. They're going to miss the boat on some consumer purchases, web purchases, because ChatGPT and some other Gemini is going to, push that business elsewhere.
mhm.
So, there's a lot of moving parts here. Again, just to make that, the personalized thing, it's like going to college and getting a degree that has no value and doesn't help you earn any more money. You kind of just wasted money on a big investment. Apple kind of went through a little bit of that. They, were trying to build out an AI. They ultimately decided to throw in the towel and just hire Gemini and Google
Yeah.
to, use their platform and their product, which was a huge win for Google. But you know what? Apple ended up winning too because they weren't just throwing money down the drain. So companies have to be careful here. They got to be thoughtful about how they want to move forward and where they want to, put their stake in the ground and decide what their value proposition is to their customers.
Yeah. Absolutely. Well, that's all we got. It's been an interesting start so far to 2026. As we mentioned, it's a market in transition. We've seen a lot of new trends coming into play so far. Small caps starting to perform well. International continuing its strong run from 2025. We're starting to see some of that Magnificent Seven technology falter a little bit, but we're only a month into the year, so we'll continue to monitor these things, stay up to date on the headlines, and we look forward to seeing everybody next month for our next monthly investment committee webinar.
Is it going to be warmer next month, Sean?
I hope so. It's got to be. It's been a brutal weather month for us. Yeah,
Yeah, that might also be weighing the market down. You never know, man. When people are cold, bundled up, they're in a bad mood, nobody wants to buy.
true. Yeah, it's
Very
gonna be
true.
fun out here.
Warmer weather brings warm markets.
Very true.
All right, guys. Well, everyone stay warm out there, and we look forward to seeing you next month. And yeah, let's go.
Let's go.
Go
Thanks,
Seahawks.
everyone.
Guys.
Bye.